Well, good morning, everybody. I'm all right. Are you all right? We're fucking all right. My name's Steve, and seriously, folks, welcome to my very short introduction to trading. I'll be taking you through over 3 very short, humorous and power-packed episodes, my trading strategy, and at the end of these 3 videos, you'll have the tools and the knowledge to have a crack, have a play, trade with some paper money, see if you can do it, see if it's going to work for you, and we'll have some fun. So without further ado, let's rip into it. As I said, my name's Steve and I'm a trader. I trade foreign exchange, and my wife has been watching me with great interest since the 23rd of February when I opened a foreign exchange broker account in Auckland, New Zealand, and have been trading ever since with quite good success. I've been trading about 6 years, and this year, from the 23rd of February, I've decided to only trade with one strategy, and that's a very unique strategy, which I'm going to share with you in these videos. So yeah, we're talking about trading foreign exchange. The same could apply to any other market. Let's talk about crypto or stocks and shares. Anywhere where there's a market with large volumes of trading, you can use the same technique, but I'm going to teach you about foreign exchange. I think it's the easiest to get into, to get out of, and we'll walk you through that. So the question begs, why trade? If you treat trading like any other small business, it's quite different. I can open a broker account today, deposit funds from my New Zealand bank account and start trading, and I can do that with as little as $100. And unlike starting a small business, imagine if you're trying to open a restaurant. You'd have to find a premise, you'd have to kit it out, you'd have to buy equipment, you'd have to employ staff, you'd have to come up with a menu, you'd have to market it and hope that people turn up and that you're successful. And 95% of other hospitality businesses that go broke, in a year's time, if you do go broke, it's very hard to get out of that business, isn't it? You have to you cancel your lease, you have to sell your equipment, you've got to let go all your staff, and that's probably quite a horrible experience. Whereas in trading, we can open an account, we can deposit some funds, we can trade. If it's for us, we carry on. If it's not for you, you take your money out, it's back in your own bank account the next day, and you can carry on. So that's why it's a pretty cool business to get into if you want to treat it as a small business. You can try trading out with what's called paper trading, and I'm going to show you how this works using a platform such as TradingView, which I'm going to show you in the next episodes. It's the most popular trading piece of software on the planet. They provide what's called paper trading, so that means you can open a demo account and you can create it with, say, $10,000 or $1,000 or $1 million, and you can go about trading without burning your own money. So if you make mistakes, it's not for real, but it'll give you a pretty good simulation as to how the markets work, and it's great fun. It's quite a cool game, if you like. Trading gives you 3 things, right? It gives you leverage, and what I mean by that is with a very small amount of money, you can use the broker's leverage. I'm typically getting 200 to 1 or 500 to 1. So for every position I take, the broker will give me 200 or 500 times the value of the trade. So they give you great leverage. It gives me a lot of freedom to trade around the time of the day that I'd like to trade. I like to trade at 7 o'clock at night. You could choose to trade at 4 in the morning. You could choose to trade on a very short time frame and be in front of the screen all day, or you can choose to trade on a higher time frame and place your trade and go to bed and wake up in the morning and see if you've won or lost. So it gives you a lot of freedom around when you can and want to do it. It gives you a lot of time back in the process. So, if you're into it seriously, I can spend, up to 7 o'clock during the day doing other things. I do other things. I've got a small business and I do music, and I do a lot of things around the property here. It gives me that time back, which is really cool. It's a game of probabilities. Okay, it's there are no guarantees, but the strategy that I'll teach you has a very high probability of success. Since the 23rd of February, I've executed over 650 trades, and they're 70% profitable, or they have a 70% probability that they're going to be winning trades, 7 out of 10. And if the ones that you win give you more money than the ones that you lose, if you have the right what's called risk to reward ratio, then you're always going to be consistently profitable. But you need a good strategy, and the one that I'm going to teach you today, or show you today, to get you excited, is it's groundbreaking. Okay, it's you'll see when I show you in a few minutes. About 90% of amateur traders, people like you and me, we're called retail traders. We lose, there's a 90-90-90 rule, so we lose 90% of our money within the first 90 days. And that's 90% of us. So 90-90-90. So you're up against it. But we're not going to trade like retailers trade. I'm going to show you another way. We're going to trade in line with the big banks. And once we understand their behaviors and how they make money in the markets, then we're going to ride on their coattails. And there is a specific pattern. There's an opportunity at a specific time, at a specific level, each and every day, and I'm going to show you that shortly. And that has a very high probability of producing money for you. It's like an ATM machine, but instead of you putting money in, it's giving you more money out. So the big banks, they don't lose. And the big banks, they don't go out of business. The brokers that we buy and sell through, they seldom go broke, do they? And between the brokers and the big banks, they have ways and means of taking your money and moving it from your account to their account, and basically screwing you over. And once we're aware of their behaviors and how they can act, then we don't need to worry so much about those behaviors because we can anticipate them. So retail traders like you and me, we fail for 3 basic reasons. The main one is that most retailers don't understand how the big banks actually make money and how they move the markets, and how they, through their specific behaviors and activities on a daily basis, will take money from the retail market to then trade with from their own trading desks and book really big profits. And I'll show you how that works shortly. The second reason is, most retailers for that reason are trading in the wrong direction. They think the price is going up. In actual fact, it's about to reverse and go in the opposite direction. They don't have a feel for the right timing, what's happening at session changeovers. I'll show you all this down the track, video 2, don't worry. And they just have it wrong. They have it wrong 90% of the time, and that's why they lose 90% of the time. And the third one is this is a really emotional game. These big banks will do specific things to confuse you. There's just inexplainable price movements. It's designed to make traders panic, to lift their stop losses, to close their positions. or make a really terrible decision, typically the wrong decision, to double down or increase their trading positions, and that's just disastrous. So I'll walk you through that. But there are three big reasons why the retailers are losing, and I'm going to step you around that. So let's just talk about the Forex market really quickly. It's a $5 trillion per day market, so $5 trillion US dollars goes in and out of the foreign exchange market. When we think about foreign exchange, we think about sovereign currencies. The finance minister would think about the world is being made up of trading partners. So if we want to sell our kiwi fruit into Japan, we would expect the Japanese to pay us in probably US dollars or New Zealand dollars. Likewise, if we want to buy 1,000 Toyotas out of Japan, they would expect us to pay in US dollars or Japanese yen, most likely. And that's largely how the international markets work, is based on nations having sovereign currencies and us needing to trade in their own currencies, and until the world settles on a single currency or we all turn to Bitcoin, that's not going to change in a hurry. The crypto market on a daily basis is about $70 billion US, and if you look at the New York Stock Exchange, it's about $20 billion US a day. So the Forex market is the oldest and biggest market, and it's the one that the only one that I trade. So in the foreign exchange market, there are basically two participants. There are retail traders, people like you and I, and there are financial institutions. And these typically are the top 10 global banks, who on a daily basis control about 70% of those foreign exchange transactions. So if I go to my browser here quickly, and I hope you can see this browser. I just punched into Google who are the largest Forex market makers, and I'll explain what a market maker is shortly. But we can see the likes of the massive banks, the JP Morgans, the UBS, the Deutsche Bank, Citibank, Bank of America, HSBC. There's about 10 really big ones. I pulled up a little picture on Pinterest here. So here are the big guys. You're not going to see Kiwi Bank or ASB or BNZ or any of those banks in this mix. These are huge global banks, and they have branches in the 3 time zones where the foreign exchange markets are traded. Those big sessions are the Asian session, the London session, and the New York session, and we'll come to that later. So that's just a quick view of who the big boys are. And these big banks, they rig the market. You will have heard of market rigging, and the official sort of Google description, if I read it here, is they fix or inflate prices to achieve profits at the expense of the consumer. And I'll talk about how the market makers are moving the markets shortly. But basically, these 10 big banks, they congregate together, and they all they trade in the same direction. They do a thing called circular trading. Now, if you want to move the market, you want to move the price of a currency pair in the market, then what typically happens is Big Bank A says to Big Bank C, mate, can I buy 500 million euros from you, and I'll sell them back to you in a few hours. And this is how they congregate. And because that transaction takes place between the two banks, it doesn't happen through a broker, or they don't pay commissions or anything like that. What actually happens in the market is that it moves the price significantly. And for the retail traders who are watching the charts, they're induced by this, because what they see on the chart, even though it's what the banks have actually created in the background, it causes the retailers to get really emotional in thinking, there's a breakout in price here, the price is going up. So the retail market piles in, thinking that they don't want the fear of missing out, and their greed takes over, They want to make money, so they all pile in and buy euros with US dollars. And a few hours later, the bank sells that currency back to the bank that they purchased from, creates a reversal in the market. At that point, all of the banks jump in. They go all in together, all aggregated, and then they go on their own counter trend, because once they've liquidated all these retailers, I'll show you how that works shortly. Once they've liquidated the retail market, they then have the liquidity or the money that they need to trade from their own desks, and then they all go on a selling spree, and that's when they book really massive profits until they do the exact opposite. And this all happens within the course of one day. There's a high of the day, there's a low of the day. I'll show you this on the charts, but it happens every single day, and there's a pattern to it. So all we have to do is to look for their behavior, look for the specific pattern at the specific time, at specific levels, and I'll show you all this, and then we jump in when the banks make their big move, and we ride on their coattails. Like a small fish, we're swimming behind a massive great white, and we're not going to get eaten. Whereas if we swim in front of the great white, good luck to you. And literally, when you are trading against the biggest banks in the world, who have a desk full of traders who are the smartest minds on the planet, the bank can take huge risks. They have deep pockets. You're up against it. Why would you take them on? Why would you trade against the real trend? So this business is about identifying trends, getting in at the start, getting out at the end. The trend is your friend until it bends or it ends, and that's what I'm going to teach you over the next 3 episodes. So that's pretty much how the banks are working, and as I say, they have the power to move the market, and during the day they can just do anything they want. They can spike the prices, and that rattles the retailers, it confuses them, they panic, they lift their stop losses, they close their trades, they double down, they do everything that's wrong, and then the banks clean them up. And it's all designed around human emotions. It's all based on fear and greed. And even the number 3, the banks, I'll show you down the track, the banks will move the market with 3 pushes, and it's human psychology that we are surrounded by the number 3, third time lucky. 2 things went bad, what's the third one going to be? It's 3 strikes, you're out. But there's a 3-3-3 thing that keeps popping up. So the banks will move the price, it'll get the attention of the retailers, they'll move it again. Now the fear of missing out creeps into our minds. We see the price move a 3rd time, and we all jump in. We think things are going to the moon, then they reverse the market. They've got you. They've completely got you. So that's what they do. Anyway, we will show you shortly how we can identify these behaviours, and there's a particular pattern. I'm going to show you the pattern, and it's highly successful. Even in over the last 20 days, I run a 20-day trading plan, which means there are 4 weeks of 5 days. We trade Monday through Friday, so a 20-day plan. And if I pull up my spreadsheet here, you'll see just over the last 20 days I opened an account with $2,042 US. As of yesterday, we're sitting at $2,243. I've made $201 US on the small account, 9.4%, which is not to be sneezed at if you think a term deposit over a whole 12 months is going to earn you about 4%. And in just over 2.5 weeks, I've made 9.4. My strike rate on a day-by-day basis is 76.9%. On a trade-by-trade basis, I'm running at a 74% win rate. So these numbers are absolutely unheard of in the retail trading business. in foreign exchange. Absolutely unheard of, and the only reason I can attest that we're getting such good results is that I'm trading in line with the banks. So you being a brand new student and having never read a trading textbook is perfect, because everything you're likely to read is going to take you down the wrong path to where 90% of you will lose your money within 90 days, and we don't want that. So coming back to just wrapping up here this introduction, and I'm just going to show you something shortly, give you a little taste for it. The patterns that we're going to show you are designed to beat the market maker. I've described the market makers are the big banks. There's actually a whole ecosystem. So me being a retailer, I trade through my broker, who is Black Bull Markets in Auckland. Now, Black Bull Markets don't have the money, the liquidity to provide for me to trade with. They therefore go to a market maker, one of these top 10 banks, and the market makers provide the liquidity to the brokers such that if I take a position and they need to pay out on it, then they have the money to do so. So the market makers extend a line of credit to all the brokers. So imagine there's 10 big banks, there's 1,000 brokers, and there's 100 million of us retail traders. This is the ecosystem that is in place, and the market maker is that entity who will take the other side of my trade. So if I want to buy euros, then they will sell euros to me. Okay, so if I'm going long, I'm buying, they are selling or going short. They're net short versus my net long, if you see what I'm saying. They're always working in reverse. Now, this market is cool. We can make money when the price goes up, and we can make money when the price goes down. And you say, well, how does that work, Steve? Because we know in housing, don't we? If we buy a house for $1 million, but we can only get 700K for it, we've lost 300K. So how, therefore, can you make money in foreign exchange when the price goes down? Well, it's the way in which we trade here in New Zealand. When I trade through Black Bull Markets, I'm trading a product called a CFD. It stands for Contract for Difference. And what that means is when I sign up with them as a broker, if I'm buying and the price goes up, they have to pay the difference in price, the contract for difference. So if I buy at $1 and it goes to $1.10, they have to pay me out on the 10 cents that the price went up. Likewise, if I'm selling currency and the price goes down, I sell at $1 and it goes down to 90 cents. The difference, the 10 cents, the contract for difference they have to pay to me. And that's great. But it comes with leverage and a thing called margin, which I'll talk about down the track. And this is the tricky bit. If I overextend myself with the 200 to 1 or 500 to 1 multiplier that they're effectively giving me, and I lose that trade, then they take that magnified amount out of my account. It goes from my account to their account, and it goes from their account back to the market maker, because the market maker they want their money back, and the broker will make money on my trade. And obviously, if I lose the trade, they make a lot of money, don't they? They just take my money straight from my account back to their account. They make 100% of my loss, and that's how the game works. So the trick is that we want to be winning more than losing, and being consistently profitable with a good strategy. So that's how we make money when we're both buying and selling. It's through the instrument called a contract for difference. And it's that product that we trade with in New Zealand. They're illegal outside of the US. In the US, if you want to trade foreign exchange, you need 25 grand in your account. You have to be a certified trader. They have to know everything there is to know about you. Whereas in New Zealand, you've got to show your passport or a driver's license, but you open an account and you trade these CFDs, and perfectly safe and great way to get into foreign exchange. So let me just walk you through just a quick example of the strategy. I'm going to go to my platform called Trading View. I hope you can all see that. And what we're looking at here is the Euro USD on a 15-minute time frame. That means every one of these little candles represents 15 minutes. And what we're looking at is prices going up and down and up and down. You can see. Now, if you wanted to trade this market knowing nothing about the market, you might as well take your money to the casino, or you might as well change your hobby to photography, because it's going to be a lot cheaper for you. Because as you can see, the price is going up and down. It's a 50-50 bet, isn't it? This is gambling at its worst. So we need more information. And like I said, we need to know about specific timings and patterns and levels. So if I just give you an example, first thing I'm going to do here is I'm going to turn on events. I'm just going to turn on the session breaks here. That's the first thing I'm going to do. So between these two lines, these two dotted lines down the screen, I'm now looking at yesterday. And yesterday, you can see we opened, the price went down, it went up, and it went down, and it went down, and down, and down, and then it scooped up here, and it closed. It closed higher than it opened. Okay, so that's the first thing I'm now looking at. I'm now looking at a session, and I'm going to break that down even further. I'm now going to turn on the market sessions. Okay, I hope you can all see that. And you can see that when the market opened in New Zealand and Australia, we just ignore this whole part of the market. We're interested in the Tokyo session, and I'm interested in the London session. Okay, so you can see in the Tokyo session, the price, initially hit this initial high of the day, and it went down and it hit the initial low of the day, and then something took place. There's a pattern that's occurred, and this pattern is the market maker pattern. And what we're looking for in the pattern is we're looking for in this case, we're looking for a W pattern. Price went down, came back up, price went down, boom. Pattern actually happened here, down, up, but you can see what I mean. It's a W pattern. Let me just redraw that. So price went down, up, down, and then it took off. Okay, that's the classic W pattern. That's the classic market maker pattern. And what's actually happened here, if I just explain to you what has happened, the Tokyo market has opened in this particular session as one where they try and attract a number of traders to take a position. And you can see the market's, it's gone up, it's gone down. There'll be buyers and sellers entering the market here, taking a punt on where they think they're going to go. And then at this point here, the market makers aggressively sell. Okay? And at that point, the traders, the retail market think, oh, this is a breakout, the price is going to continue to go down. But that's not actually the case. The market makers pull back, they let the price drop again, they give these retail market traders a little bit more hope, they pull back, they let it go down one last time. This is three shots at the bottom, at which point these retail traders are thinking to themselves, because they can't see what's happening in the future, they can only see up to here, they are thinking, yep, we're in. So there's been a lot of retailers piling in here, setting their stop losses, sort of here and here and here. I'll explain what a stop loss is later in the next video. But the market makers now seeing, they can see on their dashboards, and the really big banks, they can see all the brokers that they have, because every account manager will look after a big broker. They can see all of the brokers' open positions from all of that broker's retail traders. They can see what's on the dashboard. They can see what volume of buyers versus sellers that they have, and what value that is worth to them, to that big bank, if they liquidate them. So what happens is the bank then decides, all right, we're going to go this way, and they start aggressively buying. You can see these big green candles. These are big banks buying aggressively. At which point all of this retail market is liquidated, which means all of the open trades basically are closed. The money moves from the retail trader's account to the broker's account back into the big banks. And once the big banks have got this money, they can now trade from their own desks, and they go on a huge counter trend. So the herd went one way, and the banks, the 100 million and the herd went this way, and the banks, they go this way. And our trick, my friends, is to identify the W pattern or the M pattern. I'll cover this in the next video. And then when we see the reversal, that's when we jump in, and that's when we book a profit. Exactly the same as the banks do. So that's what happens every day in the market. And that was yesterday. I will challenge you to go to any point on any day. You'll see the same thing happen. Day before Tokyo market opened, there was consolidation in the market, just drawn here. Period of consolidation, banks just attracting, waiting to accrue positions. They aggressively move the market down. The retailers think, oh, the market's going down. The bank reverses. They come down. They reverse. They come down. We've got a big W here. We've got one, two. We've got a W pattern. Boom. The banks, they go on a reversal. That's what's happening, my friends. And this is the stuff that I'm going to teach you. And there are a bunch of other indicators that I will show you. This was a good one. Yeah, you can see the banks aggressively pushing down, basically trapping this retail market in here at the bottom. These guys are now all trapped. And then boom, look, boom, bank goes on a counter trend. That's how the market makers work. So when we see this behavior, when we see this entrapment, this enticement, in the following or at the end of the Tokyo session, moving into the London session. The London session is known for its big moves. The New York session is known for its reversals. And we will see today or tonight, being midweek in the States, there's going to be a big reversal tonight, because this market maker pattern has there's actually three pushes to the pattern, and over this week we've seen the price go up, up, up. Now the market makers all want their money back. They'll reverse the market. They have to correct the market because they're controlled by the World Bank, the International Monetary Fund. These guys won't let the market makers move the markets more than a few hundred pips a week. I'll teach you what a pip is. And in the third video, I'm going to show you how to jump on, and you can be trading with paper money, and we can jump in here at 7 o'clock PM into the London session. We can place a trade, and you'll see for yourself that you're making money. So it's all to be had over the next 3 videos, and I look forward to sharing that all with you. And I hope this hasn't been too long and boring, but I just wanted to set the scene, right? That this is it's a crazy strategy, and it's been taught to me by a guy called Steve Morrow. I'm going to pull up my browser here, just show you Steve. Here's my mate Steve. He's an ex-New York firefighter and renowned trading educator, 25 years of experience. I've done his course. I haven't paid $5,000, which he charges for the course, but I've basically done many of his webinars and watched hundreds of hours of YouTube video. And he was taught by a market maker from a big bank, who taught him everything about how the banks actually work. And after that market maker had passed away, Steve decided to take on his own trading course, and that's been his future ever since. And he's now, I think, retired. And I was very lucky to pick up on it, and That's his strategy that I'm trading with myself. I did find Steve's course quite technical. He went straight into the weeds, so I'm hoping my course for absolute beginners, which is completely free and always will be, it's out there for my friends. So Tanya and Nick and Jimmy and Brenton and Matthew, and there's a few of us now that are sort of tuned in on this. I hope it helps you all, and I hope you get something from it, and I hope you'll be very successful. And whether you're intending to trade as a hobby, or you want to turn it into a small business, or you want to set your retirement goals around it, which I'm doing, then it's a great thing to be into. All right, so that's it for episode 1. I'll be back episode 2 next week, and until then, I look forward to seeing you again. Cheers.